You know all that standard investing advice you hear everywhere? Max out your 401k, buy index funds, wait patiently for compound interest. Forget it. Seriously. That's the playbook for a comfortable retirement, not for building a billion-dollar fortune. The advice plastered across every financial blog is fundamentally different from how the world's wealthiest people actually grow and protect their money. The ultra-high net worth, we're talking people with over $30 million, are playing a totally different game. While the average investor is taught to follow the market, the truly wealthy aim to the market. They live in a world way beyond the S&P 500 tickers you know. A world of private companies, exclusive lending deals, and real, tangible assets. The difference is staggering. A typical investor might have most of their portfolio in public stocks and bonds. But the ultra-wealthy? It's a different story. According to Long Angle's 2025 Asset Allocation Study, the average high net worth member holds just 47% of their portfolio in public stocks. And for those with a net worth over $25 million, that number drops to just 38%. The rest is poured into alternative investments. That's not a small strategy shift. It's a different financial universe. This isn't about secret clubs. It's about understanding the pillars of generational wealth. We're going to break down the 4 key areas where billionaires quietly put their capital to work, the true engines of their financial empires. So, if you're ready to see what's behind the curtain, let's get into it. Before we hit the how, we have to get the why. Why do the ultra-rich bother with complicated, illiquid investments when they could just dump their billions into an index fund and go play golf? The answer comes down to one core philosophy: control. Think about it. The average investor is a price taker. You buy a stock at the market price, you sell at the market price. You're basically a passenger on a giant ship, tossed around by market sentiment, global events, and economic tides you have zero control over. When the market panics, so does your portfolio. The ultra-wealthy don't like being passengers. They want to be the captain. Better yet, they want to own the whole shipping company. This is the huge gap between owning paper assets and owning real assets and businesses. Your stock certificate is a paper claim on a tiny piece of a company. It's an abstraction. The rich want to get closer to where the value is actually created. That's why they pour so much into alternatives. A popular model gaining traction among them is the 40-30-30 portfolio. 40% stocks, 30% bonds, and 30% alternatives, specifically to diversify away from the volatility of public markets. They do it to protect themselves from market swings, generate income that isn't tied to the stock market, and, most importantly, control their own outcomes. They aren't just betting on the horse. They're buying the racetrack, the stables, and the TV rights. This mindset is the key to their entire investment strategy, and it starts with the most important pillar of all. The first and biggest alternative for the ultra-wealthy is private equity. Forget day trading on your phone. This is about buying entire companies, or at least huge chunks of them, long before they even think about going public. When you buy a public stock, you're buying into a mature company. The explosive 10,000% growth phase? That's almost always in the past. Private equity is about getting in on the ground floor. It's the difference between buying Apple stock today and being one of the guys who funded Steve Jobs in his garage. Private equity firms, and the wealthy families who invest with them, raise giant pools of cash to buy private businesses. And they don't just sit back and watch. They take control. They bring in new management, streamline operations, fund growth, and execute a multi-year plan to make the company bigger and more profitable. Then, after 5 to 10 years, they exit, either by selling it to an even bigger company or taking it public in an IPO. The returns can be incredible. While public markets have done well, one analysis looking back over a quarter century found that private equity could have generated 3 times more wealth than a similar investment in public markets. A high-risk, high-reward part of this world is venture capital, VC. VC funds bet on startups, the tech disruptors and biotech pioneers that could be the next Google but also have a huge chance of failing. For the wealthy, it's a portfolio of calculated moonshots. They know most will flop, but one huge success can return 100x or even 1000x the investment, covering all the losses and then some. So what's the catch? Liquidity. You can't just sell these investments tomorrow. Your money is often locked up for a decade or more. But for people who measure wealth in generations, not fiscal quarters, that illiquidity is a feature, not a bug. It forces a long-term view and lets them ride out market drama without panic selling. It's the ultimate game of patient, strategic ownership. The second pillar is something you almost never hear about on the news: private credit. It's not as sexy as venture capital, but for the super rich, it's a machine for generating steady, high-yield income. Simply put, private credit is exactly what it sounds like. You become the bank. When a medium-sized company needs a loan to build a factory or buy a competitor, they used to go to a traditional bank. But since the 2008 financial crisis, regulations have made banks much more hesitant to lend, especially for deals that are a bit more complex. This created a massive gap in the market, and the ultra-rich stepped right in to fill it. They, either on their own or through specialized funds, lend money directly to these companies. And in return, they collect interest payments, just like a bank. But here's the kicker. Because these companies can't easily get loans from banks, they're willing to pay much higher interest rates. While a government bond might get you a few percent, private credit loans can generate significantly higher yields, providing a predictable stream of cash. This market has absolutely exploded. What was once a niche has grown into a powerhouse. The private credit market was valued at around $1.5 to $1.7 trillion at the start of 2024 and is projected to soar to over $2.6 trillion by 2029. For a billionaire's portfolio, private credit is the stabilizer. While their stocks and private equity holdings can be volatile, the income from their private credit portfolio is contractual and consistent. It's not tied to the stock market's mood swings, meaning it can hold its value or even do well when stocks are down. It's a totally pragmatic strategy. Why let your money earn a fraction of a percent in a bank savings account when you can essentially the bank and earn a much higher, steadier return? It's another move to cut out the middleman and capture the value for yourself. We're about to get into the 2 pillars that involve real-world, tangible assets, the kind of wealth you can literally stand on. If you're finding this look into the Billionaire Playbook valuable, and if it's sparking some new ideas, do me a favor and subscribe to the channel and hit that notification bell. We go deep on this stuff every week, and you won't want to miss what's coming next. Now for the third pillar, the one everyone associates with wealth: real estate. But when the ultra-rich invest in property, they're not just buying a vacation home. Their strategy is on a totally different scale, and they play by a different set of rules. For them, real estate is the perfect trifecta: cash flow, appreciation, and incredible tax advantages. While the average person thinks of buying a home, the wealthy think in terms of entire asset classes. They dominate 3 main areas. First, commercial real estate. We're talking office towers, huge retail centers, and apartment buildings with hundreds of units. They aren't collecting rent from one tenant, they're collecting it from hundreds, which creates a diversified and resilient income stream. Second, industrial real estate. With the rise of e-commerce, this has become a gold mine. Think massive logistics hubs, data centers, and warehouses that form the backbone of companies like Amazon. Owning this space is like owning a toll booth on the digital economy highway. Third, and this is where the real ambition comes in, is real estate development. They don't just buy buildings, they build them. They buy up huge tracts of land and develop entire communities or industrial parks from scratch. It's the highest risk, but it also has the highest potential for profit. The appeal goes way beyond rent checks. It's a masterclass in leverage and taxes. They use debt to buy properties, financing a huge chunk of the purchase. The rent money pays down the loan, while the property hopefully goes up in value. It's the classic strategy of using other people's money to build your own fortune. And then there are the tax benefits. Through something called depreciation, property owners can legally deduct a portion of the property's value from their taxable income each year. The IRS says a commercial building wears out over 39 years, so you get to deduct its value over that time, which can often slash your tax bill. It's one of the most powerful tax shelters there is, and the wealthy use it masterfully. According to Knight Frank's 2025 Wealth Report, real estate is a core holding for the wealthy, with 44% of family offices planning to increase their investment in property. They see it as a tangible store of value, a hedge against inflation, and a critical piece of a portfolio built to last for generations. The fourth pillar is where wealth starts to get really interesting. This is about tangible assets. Investments you can hold, admire, and even enjoy, that also happen to be powerful stores of value. People often call them passion assets, because they usually line up with an investor's personal interests. We're talking about fine art, rare classic cars, investment-grade wine, and luxury watches. For most people, buying a nice watch is just spending money. For the ultra-rich, it's a calculated portfolio move. The Knight Frank Luxury Investment Index tracks the performance of these collectibles. While the overall index cooled off recently after years of huge growth, the long-term performance is still compelling. Over a 10-year period, assets like investment-grade wine and watches have shown returns that rival traditional investments. So why would a billionaire buy a painting or a vintage Ferrari? 3 main reasons. First, as a store of value. A rare masterpiece from a famous artist or a limited edition watch has built-in scarcity. Unlike a currency that can be printed endlessly, there will only ever be a handful of certain classic cars or jewels. This makes them a great hedge against inflation. Second, for diversification. The art market doesn't move in sync with the stock market. A financial crisis could crush stocks, but the value of a historically important car might not be affected at all. That non-correlation is a portfolio manager's dream. And third, for the emotional dividend. This is the return you can't put on a spreadsheet. It's the joy of driving that vintage car, sharing a rare bottle of wine, or hanging a beautiful piece of art on your wall. This isn't about gambling on some hot new artist. The wealthy stick to blue-chip assets with a proven history of holding their value. It's a defensive play, a way to park wealth in something real, beautiful, and shielded from the day-to-day chaos of the financial markets. Holding all 4 of these pillars up are 2 master strategies that boost returns and protect wealth: the aggressive use of leverage and an obsession with tax efficiency. First, let's talk about leverage. For most people, debt is a dirty word. It's a credit card balance or a mortgage you want to get rid of. For the wealthy, debt is a powerful tool. It's good debt, used to buy assets that will grow in value or produce income. They understand you can pay for anything in one of 2 ways. Use your own money and lose the chance for that money to grow elsewhere, or use other people's money, OPM, and pay them a little interest. As long as the return you're getting on the asset is higher than the interest rate on the loan, you're amplifying your wealth. A common strategy is to borrow against their massive stock portfolios at a super low interest rate. Instead of selling stocks and getting hit with a huge capital gains tax bill, they borrow against them to fund their next private equity deal or real estate project. This lets their original investments keep growing while they use borrowed cash to create new returns. The second lever is tax efficiency. This is not about illegal tax evasion. It's about using the tax code exactly as it's written to legally minimize what goes to the government. The strategies get complex, but the ideas are simple. They use sophisticated trusts like grantor-retained annuity trusts, GRATs, or dynasty trusts to pass wealth to future generations while minimizing or even eliminating estate taxes. A dynasty trust, for example, can shield family assets from taxes and creditors for literally generations. They make strategic charitable donations, often gifting stocks that have shot up in value directly to a charity. This gives them a tax deduction for the full value of the stock without ever paying capital gains tax on its growth. By combining leverage to boost returns and tax strategy to keep more of those returns, they create a compounding effect that the average investor just can't match. So what's the big takeaway? While most people are told to focus on stocks and bonds, the ultra-rich are playing an entirely different game. Their strategy isn't just about picking winners on the stock market. It's about building a financial fortress on 4 key pillars. Private equity, directly owning and building businesses for maximum control and returns. Private credit, acting as the bank to generate high, stable income away from stock market volatility. Strategic real estate, using leverage and tax laws to build huge portfolios of income-producing properties. Tangible assets, storing wealth in real, passion-driven assets like art and cars as a powerful inflation hedge. And it's all supercharged by smart leverage and relentless tax planning. They don't just earn money, they architect their finances to grow and last for generations. They operate on a longer timeline. They choose control over being passive, and they value cash flow just as much as appreciation. This doesn't mean buying an S&P 500 index fund is a bad idea. For most people, it's a great path to financial security. But it's important to know it's not the path, and it's not the one that built the world's greatest fortunes. The real game is played in the private markets, in real assets, and in the masterful structuring of your entire financial life. So I'll leave you with this. Now that you've had a peek into this other universe of investing, if you had an extra $100,000 to invest beyond the stock market, which of these 4 pillars would you be most excited to explore first? Private equity, private credit, real estate, or passion assets? Let me know your answer down in the comments. Thanks for watching.